Good morning and welcome to the Saxo Bank Morning Call. It's Thursday, January 17th, and here we are again the day after more Brexit drama. Theresa May surviving this confidence vote by a narrow margin along the lines of the party and the government majority there. And sterling minor volatility, slight upside. We have the chart here. Euro sterling managing to close below its 200-day moving average. I'd be a little bit cautious in getting too optimistic on its ability to continue to rally here, but supposedly room towards that 86 plus low of the range you see here. And then on cable, we see running into resistance around arguably the 61.8% retracement, but certainly well ahead of 130. The dollar coming back in a little bit stronger there and affecting the situation for cable as well as the sterling strength. What are we to make of things from here? There's a lot of complacency, it feels like, in this market that we're going to head towards some sort of a delay. The interesting thing is here, there's no agreement on how to proceed here, but we do have the default scenario being, if nothing is done, that we do have a cliff edge Brexit. That is what happens if no agreement is made. Of course, everyone's going to be scrambling to do something about that, but that is the default option. So be aware of that, and unease could creep back in. However, it's not. And Matthias, you've got some thoughts on options volatility. We're having a slight bump in the anticipation around that March 29th date, but the vols just continue to come down.
Yeah, we see vols slightly lower now after the last couple of days action. The very front end is still holding up because we have the Monday deadline as well, and seeing what's going to happen.
Yeah, you can see that on the chart here, that actually the front end is still quite aggressively higher than further out.
Yeah, so we see on the chart is the vol curve for today compared to a week ago. So we see back end is coming a little bit lower, but it's been priced really high now over the last couple of months. But we also see is that we start to see risk reversal more favor for the downside for sterling puts again.
Okay.
So we're pricing more risk on the downside than we've done over the last couple of weeks.
More so in cable, or?
Yeah, both in sterling in general. So before the Brexit vote, we had the risk reversal favoring for the top side in the unlikely event that we would actually pass the vote. But now we're back to normal sterling puts favor.
Okay. And then we have, I think across markets, getting the sense, we've talked a lot, Ola, about correlated markets, whether it's oil, whether it's the dollar, to some degree, some dollar crosses, equities, and gold. And, I remarked yesterday, we've seen this pretty decent rally in gold and silver, but the trading ranges are very, very constricted. And it just feels to me like we're at an inflection point across markets. Are you seeing that in gold as well?
Yeah, we are at a bit of a level here. If you look at the chart, we can see how we've been banging our head against this $1,300 level. This is a chart I used in my presentation Outlook yesterday, which is going to be on home.saxo later today. But 1,300 is really the case. The problem right now is everyone is turning bullish. So everyone is now talking about it's just a matter of time before 1,300 breaks. I think it eventually will, but that obviously leaves the risk open in the short term. What can drive a deeper correction here, I suppose, is continued strength in the stock markets, and if we should start to see some renewed dollar strength. The stocks looks a little bit wobbly today, so maybe we're just seeing at least the stock market taking a pause after this recent rally. But as I mentioned there on the chart, we come a long way. Really, 1245, we can correct all the way down to there before bulls should start to even worry too much.
Another, of course, something that would impact gold quite negatively would be strong U.S. data that comes in and gets the talk that we've been too quick to turn around on the Fed, I would argue.
Yeah, there's obviously all this policy mistakes and no rate hikes being priced in for the remainder of the year. That can obviously be reversed to some extent.
Right. And another thing I think is suppressing and keeping us in these pivotal ranges is the big question mark over China and what its intentions are with its currency. We saw that big move of strengthening, some speculating that there's been some sort of Shanghai Accord 2 where the U.S. promises to turn around on policy in terms of dollar liquidity and the Fed pulling back its anticipated tightening regime. And then China promises to keep its currency firm to stronger. And yet, Matthias, there's that talk, but right around the time frame of that big Powell speech that introduced so much volatility into markets and really turned around the forward expectations for the Fed, we're seeing the market turning around on its expectations of the CNY.
Yeah, so when we see quite a lot of structure being put on for dollar China downside over the last couple of months.
So the blue line, on the chart here, we're saying the blue line is indicating the skew of the options in favor of puts versus calls, and there was that big drop together with the spot.
Yeah, exactly. And now over the last week, we've seen a big spike in risk reversal again, coming from really low levels up to a little bit higher. So I think it's driven by both people now started to take off the downside structure in dollar China and looking to add something on the top side again. So we've seen quite a lot of corporate hedging flows. We see the buying of the low delta calls again in dollar China 750 levels for the 1 year as a hedge.
Okay.
So that's been driving the risk reversal now higher again.
Okay, and then maybe from a speculative angle could be the idea that all the focus on Shanghai 2 and China's very strong impulses into policy, tax cuts, triple R cuts, etc., is because the economy is remarkably weak and that devaluation risk remains. Of course, we're all questioning what's going to happen with the trade negotiations. We do have a confirmation this morning that Vice Premier Liu is headed to Washington. The question is whether there's going to be an airport open anywhere in the U.S. to greet him amidst the government shutdown. That situation getting increasingly chaotic. Not reflected at all in the market. If we look back at the 2013 experience, that was quite a different situation, although there was a lot of questions about the timing of Fed policy around that shutdown as well. This time, even though we're at a record shutdown, we're not seeing those policy implications fretted at the moment. I think increasingly, if we go another week or so, I think this starts to become a bigger issue also potentially for U.S. growth. Speaking of growth and concerns about oil, about global growth, we have the oil market, which, like we were talking about earlier, is together with everything else. It's rallied, but it's paused.
It has paused, and just like some of the other markets, it is very much also driven by the macro events more than probably what's happening inside the oil market. But if you take a look at the chart, I just put in a couple of additional charts, which from yesterday's weekly inventory report. I mean, what we saw there was crude oil production jumping by another 200,000 barrels. So we're just getting very close to 12 million now. So for now, the big collapse in oil since October has not had an impact on production. It probably won't be. We probably won't see that at least for another few months. So that's one thing which is talking against higher prices at this stage. Another thing is the gasoline inventories, which are the highest on record for this time of year, and we can see that little black line up in the top left corner how it continued to rise into the new year. So that's adding some pressure on refinery margins, and that potentially could also lead to an increase in crude stocks, and that could be negative. On that basis, 50-55 is the range right now. I think in the short term, again, depending on what stock markets do, the risk is potentially skewed to the downside.
Yeah, and we've talked. I do not have a chart on the equity market. We've talked about that 2,600 area in the U.S. S&P 500 as the global risk-on, risk-off benchmark, and we worked a little bit above there today, but then we're back in the negative territory overnight, and I think this really does look like an inflection point to me across markets as we've been talking about. And then Ole, you had a bit of a focus on softs, some developments there.
Yeah, I think we it's not something we bring in on a daily basis, but just take a look at the charts here, because we did see the movements last year, or the big rally we had towards the end of last year, which was based on the rally in the Brazilian real ahead of the Brazilian re-election. Since then, coffee has given up more or less all of its gains, while sugar is on the left there is holding on reasonably well. The left coffee is basically still plagued by too much supply. Brazilian forecasters are now looking for another potential record exports hitting the market this year. And if you just look at the one-year contango, it basically costs you 16% to be long for a year. So that's how much coffee has to rise over the next 12 months in order to actually make money on the long position.
It's such a key perspective when trading commodities.
Absolutely.
Yeah.
And on the sugar side, with the recent rally in oil prices, we're seeing an increased demand for cane going towards biofuel and ethanol, and that's supporting sugar, and maybe potentially a bull flag in the making. So that's one we should just keep an eye on.
Great stuff. And then I'm for something completely different department. A little talk about Aussie Kiwi. I like to find little themes out there that aren't so reliant on all these cross correlations across markets, something I think has potential to move, also because I think the CNY situation is kind of keeping dampening volatility in some of the majors. Although I think the yen will start to perform very well if we are seeing a move back into risk off. And I'm keeping my eye on Euro yen especially as a decent way to play that, with a little bit lower beta than some of those risk currencies versus the yen. So keep your eye on Euro yen for potential downside if we are at an inflection point and back into risk off. I've got a chart here of Aussie Kiwi. I just wanted to draw attention to this because we've seen some really interesting relative moves in the yield curves. At the front end of the New Zealand yield curve, you're seeing rates coming in lower and lower recently in the last couple of weeks, whereas Australian short rates are quite stable. So the market is starting to more aggressively price the risk that the RBNZ heads to a cut before the RBA does. and you're seeing a little bit on the chart with Aussie Kiwi so far. We saw a decent rally off the bottom. That rally has been flattered a bit by that recent yen cross flash crash, which saw almost all of the Aussie crosses involved in the crash. So, ignore that big spike low. Nonetheless, you're seeing a high established around 106.20 on a closing basis. If we close above there, I think it's interesting for a potential revaluation back towards 108 plus, given those relative interest rate movements. And now we'll move on to our calendar for today. Very briefly on earnings. We are getting into the meat of earnings season here. We saw the Taiwan Semiconductor reporting overnight. My impression was, from a very brief look at the headlines, that they did good on the income on the earnings side, but a bit of concern on the outlook, and especially linked to the iPhone. And then we have Morgan Stanley out, and I think the very interesting will be Netflix. Netflix has recovered not less than 50+% from those lows in December. I think a sentiment kind of bellwether here in some of these high valuation, high flying stocks from the previous cycle. So that's an interesting one to look at as well. And then on the macro data, we're starting to get macro data slipping because of the U.S. shutdown. So today we will not see the U.S. housing starts and building permits release this afternoon, but we will get the Philadelphia Fed and jobless claims and the weekly storage for natural gas, etc. And Ola, the OPEC monthly report, is this something that the market is particularly focused on here?
It is, because we have right now we have uncertainty on supply, on demand, and also we have the political influence, which we always has. But at least the demand side is what has been nerving the market recently because of the weakness we've seen on the economic data. So the OPEC report, again, I think I'll primarily look out for the outlook for demand into 2019. If we see any major changes there, that could have a price impact.
Okay, great. So whether it's oil, whether it's risk appetite, look for an inflection point here. I think we're at that inflection point. We're either going to accelerate, I think, up to the upside, or we're going to inflect, head back lower. And I fear the latter more than the former. As well, look for the latest Brexit headlines, the situation getting increasingly fluid by the day. That's it for today. We'll be back tomorrow with the Saxo Bank Morning Call.